Hyperscale Data Inc., NYSE American GPUS, is trading live right now at $0.3599 per share, down minus 7.72% on the day, as of 11:02 a.m. EST on November 6, 2025. That deep red number is the reality of the moment, yet the genuine, unexamined insight here lies in how that recent $125 million capital raise, the completion of a massive at-the-market equity program, didn't stabilize the stock price as most investors expected. Usually, a successful multi-million-dollar capital injection, which management immediately framed as strengthening their balance sheet and funding expansion, would provide a floor, at least temporarily. Instead, we see a dramatic drop, indicating that the market's initial reaction, and perhaps its deeper systemic concern, is focusing more on the sheer dilution of that offering, with over 255 million new shares hitting the market. The expectation was capital strength. The reality is that the cost of that capital strength, in terms of shareholder value dilution, is what's driving this stock action right now. This is a classic case of the high-risk, high-reward profile that retail traders often look for on platforms like Robinhood or through their Fidelity brokerage accounts, but which demands a cautious and deep data approach typical of a sophisticated, intelligent portfolio strategy. The general belief around hyperscale data is straightforward. It's a hybrid play in two of the hottest sectors, artificial intelligence, AI, and Bitcoin mining, operating a unique parallel compute network with NVIDIA GPUs for AI workloads and Bitmain miners for digital assets. Management has continually tried to steer the narrative toward their growing Bitcoin treasury, which they aim to push past $100 million, and their strategic positioning in the high-demand AI compute space. They've framed the company as an AI infrastructure platform provider anchored by its Bitcoin holdings. However, what the recent price movement tells us is that the market isn't buying the anchor, it's seeing the dilution. We've seen significant price volatility, evidenced by the stock's dramatic 52-week range of $0.3172 to $9.98. Just yesterday, following the announcement of the completed equity program, the stock saw a temporary spike, hitting close to $0.40, yet today that gain has been entirely wiped out and then some. This suggests that the initial buying euphoria, likely from short-term traders reacting to a headline, quickly evaporated when the reality of the increased share count and the persistent operational challenges of a small-cap, diversified company set in. The sheer volume of over 16 million shares traded already this morning, well before noon, underscores that this is a period of intense selling pressure and high turnover. For those who engage in online investing, this kind of rapid fluctuation is a key signal that emotional trading is at play, making disciplined analysis even more crucial. Looking closer at the recent activity, the last 2 weeks have been a roller coaster. The stock traded up sharply following the announcement that it was expanding its Bitcoin mining capacity by ordering new Bitmain S21 Pro miners, and that it intended to launch an on-demand NVIDIA GPU cloud service from its Michigan campus, showing the market's appetite for the core business narrative. Subsequent news of its Bitcoin treasury growing to $73.5 million, representing a significant chunk, roughly 61% of the market capitalization at the time, should have been a strong positive catalyst. Yet even that news preceded a day where the stock declined. This is the tension. The company is delivering on its stated strategy, acquiring assets and securing capital, but the market's sentiment is overriding these positives. This disparity forces us to question the structure of the business itself. Hyperscale Data is not just a Bitcoin miner, it's a highly diversified entity, a holding company with segments in finance, energy, real estate, and more, a structure inherited from its former identity, Alt Alliance. This complexity, which includes subsidiaries like Sentinum for crypto mining and colocation, and its plans for divesting Alt Capital Group, introduces a layer of fundamental uncertainty that pure-play AI or Bitcoin companies don't face. Investors on platforms like SoFi Invest or using a simplified self-investing approach might be lured by the NVIDIA stock or Bitcoin exposure without fully appreciating the complex balance sheet and operating structure underpinning the ticker. The historical context here is a continuous narrative of high-growth aspirations meeting the harsh realities of execution and capital needs. The company was formerly Alt Alliance, and the name change to Hyperscale Data Inc. was a clear signal of its strategic pivot towards the in-demand AI and compute infrastructure space. While the broader hyperscale data center market is forecasted to grow at a CAGR of over 20% globally, fueled by the demand for large-scale cloud services and AI workloads, Hyperscale Data Inc. itself remains a microcap player. Its recent reported estimated total assets of $330 million, $1.02 per share, and estimated net assets of $150 million, $0.47 per share as of late October 2025, while positive in terms of book value relative to the current share price, must be weighed against its reported significant debt reduction efforts and a volatile earnings history. The challenge isn't the vision, it's the balance sheet and the operating drag from the non-core assets. For any individual brokerage account holder, the primary question should be, will the potential value of the core AI Bitcoin assets ever be cleanly realized by shareholders, or will it continue to be consumed by the capital needs of the other segments? The announcement of a planned divestiture of Alt Capital Group in the second quarter of 2026 is an attempt to address this, but a long time remains until that potential simplification materializes. This waiting period allows market anxiety to continue to play out, especially for a stock this sensitive to price-to-book ratios. The core business model, the parallel compute strategy, combining high-density NVIDIA GPU clusters for AI and high-efficiency Bitmain miners for digital assets, is conceptually sound, playing into two strong tailwinds. The company is actively expanding its compute capacity, which should theoretically increase its revenue potential from both AI cloud services and mined Bitcoin. However, the execution depends heavily on securing power and infrastructure, a critical constraint in the hyperscale market. The flagship Michigan campus is the central piece of this puzzle. The success of their planned on-demand GPU cloud service, set for launch in 2026, will be a true litmus test of their operational capability. It positions them directly, albeit at a much smaller scale, against giants who are also heavily investing in NVIDIA stock and GPU capacity for their cloud offerings. They are also building a substantial Bitcoin treasury as a financial asset, which serves as a kind of internal collateral, a strategy that resonates with a specific type of investor, but also links the company's valuation to the often wild swings of the crypto market. The announcement that their Bitcoin holdings represent 97% of the company's market capitalization as of late October 2025 is a telling metric. It means the market is essentially valuing the entire operating business, the data centers, the infrastructure, and the non-core assets, at near zero. This is a highly contrarian take for a potential investor using investment help tools or exploring Fidelity ETFs and Fidelity mutual funds that might hold the underlying technology companies. This is a structural mispricing if you believe in the AI business, or a completely accurate risk assessment if you fear the dilution and complexity. As we look to the future, the expectation is that the completed $125 million capital raise provides a clear runway for expansion, allowing them to scale their AI compute offerings and push the Bitcoin treasury past $100 million. The reality is that the market is expressing deep concern over the massive share overhang. The next catalysts to watch are very specific. First, the weekly updates on their Bitcoin treasury, which if consistently executed through their dollar-cost averaging strategy, could slowly rebuild confidence. Second, the progress on the on-demand NVIDIA GPU cloud service launch in 2026. Any early-stage contracts or major infrastructure deployment milestones will be critical. Third, and perhaps most important for addressing the valuation issue, the concrete steps and timeline for the divestiture of the non-core assets, Alt Capital Group, which is expected to occur in the second quarter of 2026. A cleaner, more simple corporate structure focused purely on AI and Bitcoin would likely attract a higher valuation multiple. The risk, of course, is that the need for cash persists, leading to further highly dilutive capital raises, or that the market for AI compute becomes too crowded and competitive, especially as NVIDIA continues to dominate the hardware landscape, making it difficult for a smaller player to carve out a profitable niche. Another risk comes from the sheer volatility inherent in their asset base. Any major crash in Bitcoin's price would immediately erode the supposed anchor of their balance sheet, dragging the stock down with it. For investors considering the stock, whether through an interactive brokers trading platform that favors high-volume, high-risk trades, or a more curated Schwab Intelligent Portfolios approach that typically avoids microcap volatility, the price action is screaming caution. This isn't an investment based on steady earnings growth or predictable cash flow. It's a highly speculative investment on the successful execution of a complete corporate transformation. The management team is staking the company's future on two volatile and high-capex businesses. Their success will depend on their ability to secure favorable, low-cost power